Hi everyone. Very sorry. We are experiencing this technical problem again. Anybody can see or hear me? Hi, Jeff.
Hey.
Hey. I'm sorry. Right. Okay, let's give it a minute for the audience to switch over.
No worries.
It's a tricky day.
I know. Hang on.
Okay. Thank you everyone for your patience. Okay, maybe Jeff, let you continue.
Yeah, should we wait? You're okay? I mean, okay, sure.
Right now there's only 20 people.
Yeah.
So let's wait a little bit. Is that okay, everyone? Let's give it 2 minutes.
Yeah, see a few more coming in now.
Yeah, great.
I really like the platform. I mean, there's obviously a few little bugs, but it's one of the most innovative and interesting platforms I think I've ever worked on. So I hope you can get the little bugs sorted because it has a lot of potential, this one. I guess.
Yeah.
I guess that's the thing with things that, always have a lot of potential. Can be, a little bit of teething, but more potential.
True. Hopefully, we will be contacting the technical team immediately after this.
All right.
All right.
Let me restart on that slide, and I'll ensure I'll talk slowly. And thank you so much for the 20 folks that come back.
Yeah. Thank you, everybody.
I've only got a few more minutes. A couple of minutes left.
Yeah, you can jump to the slide, whichever slide you stopped at.
Okay, we'll start again. My name's Jeff Howie, and I'm sorry.
We can only laugh at this problem.
Yeah, so I'll tell you, it certainly is a year that we've learned to be a little bit more patient, hasn't it?
True.
Yeah. Okay. So I just want to talk a little bit more about these strong performers, because a lot of the inherent trend of these stocks has been their comparative ability to continue to operate under these severe conditions of these lockdowns and social distancing, which at the end of the day is until the vaccine is well distributed, that's the way we're fighting COVID-19. So as we say, Keppel DC REIT, it was the strongest, and it had some great numbers and also had made those acquisitions, as we said. But it's interesting too that this stock per se, it's you might call it tech adjacent, not tech, but it really is our internet stock, because internet enterprises make up close to 50%, as we said, of the portfolio's rental income. And according to these minutes, if you look at the minutes in the FY18 AGM, the Keppel DC REIT's management, he reiterated the policy is not to share tenant names. It's not to share tenant names rather than just share the trade sector of the REIT clients due to the confidentiality to the location of the data centers, which is a very important part of the client relationship. And he noted that the clients included hyperscale cloud providers that are now amongst the largest companies in the world, and the risk of default is very low. And it believes data center remains robust. There's underpinned by, of course, these strong digital trends that we're seeing in rapid cloud adoption, smart technologies, big data analytics, and of course, 5G deployment. For Parkway Life, it's Asia's largest listed healthcare REIT, and 4% of its growth in net property income for the first 9 months of 2020, it really comprised of contributions from 3 nursing rehabilitation centers in Japan and higher rent from Singapore properties, as well as some appreciation of the Japanese yen. So the Parkway Life, it owns well-diversified portfolios of 53 properties that are located in APAC. The total portfolio size is around $2 billion, and it has this strong capital structure because 49 of the 53 healthcare properties are located in Japan. Hence, the group has to be very proactive in managing its exposure to interest rate risk and, more importantly, foreign exchange risk. And as of 30 September, the group maintained what they call an effective low all-in cost of debt of 0.54%. So that's basically their big interest rate per se, without any long-term debt refinancing needs until June next year, June 2021. So I guess to mitigate refinancing risk, the group targets, it puts these loan facilities in place to term out their maturing debts gradually before 2021. And I think it has almost 90% of the interest rate exposure also hedged with an interest coverage ratio of around 17 times. So that means its gearing is around 38.6%. And it also has all these Japanese yen net income hedges in place all the way through to 2025 to shield against Japan currency volatility. So I did kind of rattle a little bit here, but the key point is it has that very strong capital structure, and prudent capital management is a really sub-brand, if you will, of the Singapore REIT sector. I guess the maple trees as well is also the maple trees as well is also quite important. Prudent capital management has been seen there as well. For its first half, ended the 30th September, Mapletree Logistics Trust and Mapletree Industrial Trust, they both generated net property income close to $400 million, which was up 5% year on year. We have gross revenue was around $230 million, which was up 2.5%. Mapletree Industrial Trust also joined the STI on the 22nd of June, and it has increased its portfolio exposure to data centers from 0% a few years back to 18%. I think so it's from 0% to 18%, and then from 18% to 30% last year, to 30% to 39% this year, and again up to 41% just now. So it's also been basically making these acquisitions in these data centers for the last 3 years or so. Mapletree Industrial Trust, it's not just making acquisitions of data centers, but as we said, the ability to recycle assets and diversify property pipelines is also very important. Mapletree Industrial Trust has exemplified that quite a bit. You look at in July 2019, Mapletree Industrial Trust, it took this strategic step to grow its high-tech building segment here in Singapore. So it's redeveloped this flatted factory cluster here in Singapore. The total cost is around 260 million Singapore dollars, and the redevelopment is a built-to-suit facility for global medical device company headquartered in Germany, and that will account for around 24% of the enlarged ground floor area. That will enable Mapletree Industrial Trust to unlock value for the portfolio by repositioning this cluster per se into a high-tech industrial precinct. And basically able to utilize now all this untapped plot ratio. So it was also an important part of our REIT sector here is to have the closest relationships possible with the tenants. And the Mapletree Industrial Trust was able to relocate some 67 of its 108 affected tenants in this redevelopment. So I guess we are a hub, if you will, for data centers, and I think that's been a key attraction for the big companies like Tencent and so forth. I think it was last year Equinix said the attribution of our DC market success was a lot of various government initiatives to enhance industrial competitiveness, which includes the Green Data Center Standard, Personal Data Protection Acts, and we are a pretty mature data center market, if you will. So there's a lot of these sub stories and interesting parts of our REIT sector, as we discussed with the this big rotation we see from the data centers and the logistics and the industrial properties into hospitality REITs and the retail REITs per se. A lot of these REITs had some pretty not so strong performances. Global data center REITs were up around 20% in the first 10 months of 2020. Global industrial REITs were flat. Global hotel REITs were down as much as 45%, and global retail REITs were down 30%, with global office REITs down 20%. Now, rallies in November saw a lot of rotation into these subsectors. So data centers basically trimmed their year-to-date gains to 15%. So they went from 20% to 15% up. The hotel REITs, they trimmed their losses from down 45% to down 30%. And global retail REITs also trimmed their losses quite significantly from down 30% to down 20%. So just to give you, that was the big rotations per se. And globally, these 800 REITs across the world, they have around 2.5 trillion Singapore dollars in combined market capitalization. And we have a lot of that global type of REIT buzz, if you will, in our REIT market here as well, with so many of the REITs with properties all across the world and the region. What we and as we said, key drivers going to 2021 will be, as we said, the prudent capital management, the ability to recycle assets, diversity of the property pipelines and portfolios, and we will we basically aim to provide these insights to our investors mostly through content rather than these presentations, mostly through reports daily. We write reports daily, but some of them. The bigger ones that are more useful, I guess, for the REIT investors, they come out every week or every month. So we've got a lot that we can offer you in terms of more insights, which is really educational, or basically helping you understand a little bit more about our sector, not just throwing the prices into our ticker tape board and so forth, but also giving you a little bit of reason for why those prices have performed the way they have. So as we said, we've got these investor resources. You can scan that QR code, the Gateway report, the Telegram reports, the stock screener, the apps. We basically try to be inclusive as possible to all our investors and make sure that we are able to reach all the various investors, not just in Singapore but across the world. So I'll finish off here. As I say, I'm an Aussie. I don't look very Singaporean, but I've been in Singapore for 12 years, and 10 of those years has been with the SGX. I'm an Aussie. I grew up in Hong Kong, so I did. Growing up in Hong Kong, we did used to come to Malaysia a lot because my dad was a Dragonair pilot, and that was the airline that Cathay Pacific absorbed in order to stay alive. And MAS was a big partner. Malaysian Airlines was a big partner of Dragonair, so we did have a lot of holidays in Malaysia, flying on Malaysian Airlines and so forth when I was a kid. So that's just a little bit about me personally. I just wanted to share that. I guess it's getting a little bit late, but if anyone's got questions, please throw them on the chat. Thank you.
All right, thank you very much, Jeff, for your insightful overview of the SG REITs market. Yes, to the audience, if you have any questions, please feel free to type them in the chat box below. No questions? Anybody? Any questions? Let's wait a little while.
Sorry. The IPOs have been We've had a couple of REIT IPOs this year. Elite Commercial REIT was the UK office REIT, which has fared fairly well and continued to expand its portfolio, making acquisitions. But looking forward for the IPOs, we're seeing more and more that the new listings are being driven by US, Asia Pacific, Europe, and so forth from outside of Singapore. Student accommodations, one asset that we haven't got yet, but has been talked about for some time, and that might be something to look forward to in 2021. And obviously, the China recovery is really important for our market, for all our markets, so to speak, and hence we're probably expecting more REITs from China as well next year potentially. Yeah, there you go. So there's a really good question by Mr. Chi. What's your view that Ascendus REIT is having lower return but higher net institutional inflow? That is interesting. So Ascendus REIT has commanded quite a lot of net institutional inflow this year. It's been one of the highest. But the thing is, with Ascendus REIT, the market and the flows tend to follow the prices. So retail, we see more variability in that retail investors generally in Singapore are value investors, and they buy more, and we see more net retail inflows when prices are at a discount to where they have been. But with Ascendus REIT outperforming, a lot of those fund managers that track the big indices like the FTSE EPRA NAREIT indices we discussed, they are kind of almost like they're forced to invest and keep putting their institutional flows into Ascendus REIT. So as Ascendus REIT outperforms, and you got to remember, before CapitaLand Integrated Commercial Trust was formed with Capital Mall Trust and CapitaLand Commercial Trust, Ascendus REIT was our biggest REIT. And hence sometimes a bit of a proxy for the REIT sector. Hence we did see a lot of those net institutional inflows, and then comparatively lower returns is there. But the key to that is to compare the, I guess that was the long answer to the question. The short answer to the question is you got to compare the net institutional inflow to the market capitalization of the REIT. So Ascendus REIT will always have the highest net institutional inflow, but it's also got one of the highest market capitalizations. So if you divide the flow by the market cap, you might see a little bit more evenness in terms of or less peripheral in terms of the relationship between the flow and the return per se. Because, so it's like DBS, OCBC, UOB, they will always have the highest net institutional inflows or outflows just by the virtue of the size. So that's why it's good to go one step further, take the market cap of the REITs or the stocks and look at the flows proportionate to market cap.
All right. I hope that answers. Oh, okay. We have another question from Kelvin.
Yeah, that's a good question as well. With First REIT, with a few, there's an issue with the manager talking about the tenants and the ability to service the agreements that are currently in place. So First REIT has not seen the rotational inflows this year like Parkway Life has seen. So Kelvin, that's a really good question, and this question really goes through to JT in his first speech. He's talk about the real importance of looking at that high value, or looking at the yield and looking at the distressed selling off, but also having a really good important look at the financials. So for much of the time this year, particularly since April, a lot of focus has been on getting clarity in terms of the relationships with the tenancies and the ability to hold those tenants for the next couple of years. So you've really got to watch the news on that one. If you want to look at long-term holding, I mean, there's a number of REITs. You don't just have to look at the distressed ones for long-term holdings per se, but definitely follow the corporate announcements on First REIT. That would be my first point to make.
Okay. Do we have we have time for one more question? Anybody? So if not, I think our time is up. So thank you very much, Jeff. Thank you so much for your time, and thank you everyone for having the patience to bear with our technical difficulties. We hope that in the next webinar we won't be facing this issue. So thank you very much. It's the end of the session now. So if you are interested to review this video, we will be hosting them in our Share Investor Malaysia Facebook. Probably it'll be in parts, but we'll try and make it back to you. But thank you very much. Until the next webinar, my name is Danny, and I hope everybody have a good evening. Thank you. And thank you to our speakers as well.